Welcome to P2 Corporate Reporting. In this section, we are going to look at the reporting requirements of small and medium-sized entities, SMEs. SMEs are the backbone of many economies, and during your career, you will come across many. So let's learn about their reporting requirements. You have not seen the standard IFRS for SMEs in F7. So let's look at it here. IFRS for SMEs is an independent standard which incorporates the accounting principles based on the existing IFRS. These principles have been simplified to suit SMEs and their information needs. The reason IFRS for SMEs was introduced in 2009 was to produce a framework for SMEs that generates relevant, reliable, and useful information, which should provide a high quality and understandable set of accounting standards suitable for SMEs. The IFRS standards were tailored for larger companies, and the information need from the users of the financial statements of SMEs is much less. The cost of compliance with the IFRS was a burden on many small businesses. This standard omits the topics that are not relevant to the users of financial statements of an SME and allows SMEs to use the easier option of accounting policies, and it simplifies many of the principles for recognizing and measuring assets, liabilities, income, and expenses that are in the full IFRS. For example, a small shop that is deemed an SME in its jurisdiction, it's unlikely that the users of the financial statements will need to see segment reporting or earnings per share in their financial statements. Most SMEs are owner managed, so some of the information requirements are irrelevant. Therefore, it is important to note that if a topic is not covered in the standard, there is no mandatory default to full IFRS. So let's begin by asking, what is an SME, or a small to medium-sized entity? This standard guides us in identifying what an SME is. An SME is a small or medium-sized entity that does not have public accountability and publishes general-purpose financial statements for external users. So for external users who are owners but not involved in managing the business, existing and potential creditors, and credit rating agencies. How do we know if a company has public accountability? It is publicly accountable if its debt or equity instruments are traded in a public market, or it is in the process of issuing these for trading in a public market, or it holds assets in a fiduciary capacity for a broad group of outsiders as one of its primary businesses. If this is incidental, it is not necessarily publicly accountable. You will come across this in banks where they hold many people's life savings. The standard does not contain a limit on the size of an entity that may use the IFRS for SMEs, provided it does not have public accountability. Instead, this is left up to the national regulator. Usually it's determined by the value of the balance sheet, the amount of turnover, or how many employees the company has. You should look at these requirements or traits for an SME in your own countries so you are familiar with them. If a company then chooses to apply IFRS for SMEs, they must fully apply the standard, just like any other standard. They cannot choose between IFRS and the IFRS for SMEs. They must always apply IFRS for SMEs. Under IFRS for SMEs, a complete set of financial statements is statement of financial position, either a single statement of comprehensive income or two statements, an income statement and a statement of comprehensive income, statement of changes in equity, statement of cash flows, and the notes. in the statement of changes in equity under IFRS for SMEs, if the only changes to the equity during the period are from the profit or loss, payment of dividends, correction of prior period errors, or changes in accounting policy, a combined statement of income and retained earnings can be presented instead of both a statement of comprehensive income and a statement of changes in equity. This is different from the full IFRS, which requires a statement of changes in equity to give a reconciliation of the equity from the beginning to the end of the period, so it reduces the reporting burden on SMEs and simplifies the financial statements. The standard also deals with the treatment of property, plant and equipment, and they can be valued using the historical cost model or the revaluation model. Interestingly, the full IFRS allows borrowing costs and R&D costs to be capitalised under the correct circumstances. But under the IFRS for SMEs, these costs are expensed in the year. Under the IFRS for SMEs, any revaluations of intangible assets are prohibited by the standard. It also gives non-tangible assets a finite life. If a useful life cannot be determined, then the life of 10 years is assigned. The full IFRS IAS 38 intangible assets allows the cost and revaluation model to be used on intangible assets, such as goodwill. It also allows the assets to have an infinite life. Whereas, interestingly, IFRS for SMEs states that intangible assets should be tested for impairment only when there is an indication of impairment, instead of annually. This makes preparing the financial statements less onerous. The treatment of an investment property is also a little different. The standard allows the company to use the fair value if it can be measured reliably, without undue cost or effort. If this is not possible, the entity must treat the investment property as property, plant and equipment as per the standard. You know from your studies in IAS 40, investment property, that the fair value or cost method can be used. The standard doesn't require non-current assets held for sale to be put in a separate section. It identifies assets held for sale as an indicator that the asset is impaired, as you should already know that assets held for sale must be classified as such in the financial statements under IFRS 5. When recording the costs of business acquisitions, IFRS for SMEs is very interesting because its treatment of the transaction costs differs a lot from the treatment of these costs under IFRS 3, business combinations. The SME can include the transaction cost or any cost directly attributable to the business combination in the value of the asset, unlike IFRS 3. This is very interesting and again shows the adaptation of the standard for smaller businesses, where the acquisition of a business combination would be a significant venture and many new costs would have to be paid. In the employee benefit section, we looked at employee benefits, and IFRS for SMEs records defined contribution schemes just like you have learnt, by recognising the annual expense in the financial statements. However, the more onerous defined benefit scheme, at least from a corporate reporting perspective, the defined benefit plan can recognise the liability based on the net present value of the defined benefit obligations less the fair value of any plan assets at balance sheet date, which is what we have seen before. However, if this cannot be done without undue cost or effort, the entity can simplify its calculation and ignore estimated future salary increases, ignore future service of current employees, and ignore possible future in-service mortality. So you can see the standard is simplifying the full IFRS standard to the circumstances of an SME. So I have given you an introduction to the standard and highlighted to you the main differences between the full IFRS and IFRS for SMEs. This is not an exhaustive list. This is just the main ones you will come across in your exam. Given that SMEs play such an important role in the world's economy, you should be familiar with the standard. Be able to identify a SME on its public accountability and on its size according to your jurisdiction. Thank you.